So let's talk about Avenue Supermarts, or as pretty much everyone knows them, DMart. Right now, in early 2026, they're at a really fascinating crossroads. You've got a huge leadership change on one hand and a new, very real competitive threat on the other. So we're going to break down the bull case, the bear case, and what it all means for the company's fundamental strength. And the story really kicks off right at the top. On February 1st, 2026, the longtime CEO Neville Noronha, this is the guy who was truly the architect of DMart's incredible growth. He passed the baton. The new CEO, Anshul Asawa, a veteran from Unilever. That's a big deal because it signals a potential new direction, bringing a whole different skill set to the table. Okay, so let's start with the good stuff, the bull case. Why are people still so optimistic about DMart? Well, the argument for their success really boils down to three key things: their unbeatable cost structure, their powerful profitability, and just a massive, massive runway for expansion across India. First off, despite all the noise about competition, the company's profit engine is absolutely humming. Just look at the latest Q3 results for fiscal year 26. Net profit jumped a solid 18.3% year-on-year. And revenue? It surged past the 18,100 crore mark. What this tells us is that the fundamental Damani Flywheel, that core strategy of owning their own land to keep costs rock bottom and pass savings to us, is still working perfectly. And this right here shows their core strategy in action. You've got competitors out there burning through cash to promise 10-minute deliveries. Meanwhile, DMart is proving that for a lot of people, value still wins over speed. They've actually expanded their EBITDA margin to 8.1%. Now, that's not just some number on a spreadsheet. It's hard proof that their everyday low price model is incredibly efficient. It lets them get more profitable, even when the market gets tough. Now let's talk about physical growth. The room they have to run here is just immense. They're sitting at 442 stores right now, but they see a clear path to a potential 2,200 stores. So the key takeaway is this: they are nowhere near saturation. And a huge part of this plan involves a big push into northern India, really breaking out of their traditional stronghold in the West. All right, every story has two sides, right? So now we have to flip the script and look at the bear case. And it's really important to understand this argument isn't about some internal weakness at DMart. It's all about a brand new structural threat that's popped up in Indian retail: quick commerce. And you can see the direct impact right here. The rise of platforms like Blinkit and Zepto is starting to show up in a really key metric. We're talking about like-for-like growth for their mature stores, the ones that have been open for more than 2 years. That growth has slowed to 5.6%. So what does that tell us? It suggests that in the big cities, at least some shoppers are starting to choose the convenience of "I want it now" over DMart's classic stock up and save model. So the big question is, what's management doing about this very clear threat? Well, they've laid out a super clear counter strategy, and it's not about trying to beat quick commerce at its own game of speed. Instead, they're doubling down on their core strength, value, while at the same time making their own online presence a whole lot smarter. Here's what that pivot looks like in the real world. DMart Ready, which is their online business, has actually pulled out of 6 smaller markets. Now you might ask, why? It's all about concentrating their firepower on the major cities, where the quick commerce battle is the most intense. The goal is to perfect their own model there, and they're targeting a massive 4,000 crore rupees in digital revenue. Think of it as a strategic retreat to win the much bigger war. Okay, so you've heard the bull case and you've heard the bear case. Now, let's pull it all together by looking at the company's valuation and its incredible financial resilience. And honestly, this is where the story gets really compelling. You have to remember, back in 2021, the hype was unreal. The stock peaked at a dizzying price-to-earnings ratio of 170 times. Well, the market has completely re-rated the stock since then. That PE multiple has compressed all the way down to a much more grounded 86 times. It's like all the speculative air has been let out of the balloon, and the stock is now trading far below its 10-year average. And you can see this valuation story playing out perfectly on the technical chart. Since 2021, the stock has essentially just been trading sideways. It's been stuck in this wide consolidation range, bouncing between roughly 3,400 and 5,000 rupees. The real catalyst to break out of this range will likely be how well they execute that strategy we just talked about. So ultimately, when you filter out all the short-term noise, the story of DMart is one of resilience, not disruption. And the bedrock of that resilience
It's their absolutely pristine balance sheet. A debt-to-equity ratio of just 0.07 is almost unheard of for a company of this size. This financial fortress gives them the power to weather any storm and execute their long-term plan without any pressure.
So all this leaves us with one final massive question. You've got a new leader bringing in fresh expertise, you've got a valuation that has been significantly de-risked, and you've got a clear strategy to fight back against the market's biggest threat. So is this long period of just treading water, this consolidation, actually just the foundation being laid for the company's next great phase of growth? That is the billion-dollar question for investors today.